now, for our next educational talk, we're going to have Zach as partner at Lockton Lord, and he'll be talking about some of the regulatory challenges with rebating, which is a kind of a very interesting and important topic for InsurTechs looking to improve customer engagement. So, Zach, you want to come?
Sure. Hi everyone, I'm Zach Lerner, partner at Locklord. An audience member told me the first 15 seconds are the most important, so I'm going to just spew some expletives about the Houston Astros and let you enjoy that. So I'm going to talk a bit about rebating, time inducement issues in the United States with respect to insurance products. It really does expand past just carriers and producers. As we see other InsurTech firms enter this space, everyone kind of needs to think about it because we're kind of all in this together, how we're marketing each other's products and getting them out to market. So, as an initial matter, nearly all states have some sort of statute of regulation addressing prohibitions against tying and inducement practices. This general rebating prohibition is not consistently seen among all U.S. jurisdictions, but we are seeing a flood of InsurTech companies porting their business models over to the U.S. and having to tackle these prohibitions which don't exist in the same capacity, say in the EU, for example. Ironically, while most of the anti-inducement statutes in the U.S. Don't expressly reference the word tying or the practice of combining products together, most real-world violations of the anti-inducement restrictions involve a tying practice. So generally, states do not allow for a construct whereby in order to obtain insurance, one product must be purchased with another as well. This also includes receiving discounts on products as a condition of purchasing another. So New York has been particularly on top of this issue in the tech space. In its 2018 circular letter, it notes that insurance producers are improperly titling wireless communications insurance with the purchase of other products such as service contracts or cell phones. Some states, though, are more lax or have traditionally been more lax when it comes to tying. So, for example, Maine has a bulletin that says that as long as there's alternative sources of insurance available, tying is not necessarily impermissible. So while trying to understand tying often involves understanding complex business transactions, traditional inducement and rebating activities are pretty simple to understand. If you offer incentives to purchase insurance and you don't fit into one of the exceptions, you're probably violating the law. The most common practice, of course, is when an agency provides rebates of premiums to insured as an incentive to go with them. In addition, we see association models throughout the U.S. whereby insurance benefits are offered exclusively to association members. While these models don't necessarily violate the law, most states require that the purchase of insurance actually be optional and not a mandatory condition for joining that association. There's also some fictitious group laws to consider and some general group policy restrictions as well. So I know from my experience, group policy structures are being increasingly utilized in the EU, but some states like New York substantially restrict using a group P&C insurance structure unless you use some sort of federal vehicle such as a risk purchasing or risk retention group. Interestingly to me, the evolution of InsurTech has brought a new wave of inducement issues in the form of technological side products such as Fitbits, heart monitors, etc. And technically, while these add-ons may be tied to risk mitigation factors, which I'll discuss in a minute, they're still technically in violation of traditional inducement laws when provided by an agent to insure if it's not in the policy. The rating side also has challenges as well. This emergence of dynamic-based pricing, where you're such as rebating premiums on safe driving or use-based pricing based on the usage of a product. If it's not in the policy, you risk violating applicable law. So before I get to the exceptions to rebating restrictions, I think it's important to discuss for a second the cousin to rebating, which is commission sharing. Generally, agents cannot share commissions with anyone who engages in the sale, solicitation, or negotiation of insurance if that person doesn't hold an insurance agent or producer license. While most states allow for commissions to be shared with individuals or entities that do not engage in those activities, there are still a few states that prohibit all forms of commission splits unless it's between licensed producers. Another avenue to consider is that most states allow for non-licensed individuals to be paid what are called referral fees. But in some states, such as New York, these referral fees may only be paid if the unlicensed individual doesn't discuss policy terms and critically is not paid based on the successful sale of insurance. In my practice, I've actually seen an explosion of these kinds of arrangements because a lot of InsurTechs are very savvy on the technology side, obviously, but some are not yet fully mature on the regulatory side, so they'll often engage licensing firms to help out. I'm sorry?
Is it too early to ask a question that as an employer, as a broker, that we can bonus out our employees and not be in violation of the DFS requirements?
Well, we're on a strict time frame.
How do we induce our employees to do their job without
Right.
financial
Well,
compensation?
employees is a different story. It really depends, obviously, if the employees are licensed or not. Employees can do functions within your firm without having a license, as I'm sure you know, but New York and all the states heavily restrict what they can and cannot do and how they're paid. So obviously what we see, and I'll move on in a moment, is we see a lot of flat fee arrangements between InsurTechs and their other consulting firms and other strategies to, I don't want to say circumvent the law, but to fit in a appropriate compliant area. So there are, of course, a number of prominent exceptions to rebating prohibitions. First and foremost, if the rebate is in the policy itself or the tying is in the policy itself, it's usually going to be acceptable. However, admitted products must be filed for approval with applicable insurance departments in most situations, and getting an inducement or a tie-in approved by a department can prove tricky sometimes. Many states also have exceptions for de minimis rebates, so New York allows up to $25, although other states require permissible inducements to be related to the marketing or insurance rather than free Astros or Yankee tickets. Another fairly nuanced exception is the controlled business exception. This basically allows for producers that are placing business for themselves or their affiliates to still get commissions and not have it be considered a rebate, but it's usually restricted. So New York says it can only be up to 5%, I believe. So finally, and perhaps most importantly for InsurTechs here, is the emergence of the exception of value-added services, or VAS. So the NAIC is currently contemplating model legislation and taking industry comments on how far it should go in exempting a VES from the rebating and tying restrictions. These types of services include loss control services that can be reasonably expected to mitigate costs, such as leak prevention systems, home sensors, and even wearable devices in the life and health space. Some states like Florida already allow for some forms of VAS inducements if the insurer agrees to allow the agent to make such offerings. Some other states want to go further. Ohio has suggested allowing for any VAS so long as it's offered in a non-discriminatory manner. Some states want to go even further and allow any inducement or rebate to be put in into the offering if the insured actually requests it. So we see a lot of this in the employee benefit space. So while there's a lot of uncertainty in this area, one thing that we know is that the evolution of InsurTech has revolutionized the way these issues are being discussed and augmented throughout the country. So I suspect a year from now, these inducement, rebating, and tying laws are going to look much different, hopefully in New York, but definitely across the country. Thank you very much. We don't have time for questions, but that's my picture.